thanks to both of you for joining us here this afternoon. Alessia Berardi, you are Head of Emerging Market, Macro and Strategy Research at the Amundi Investment Institute. And Francesco Sandrini, you are Amundi's Head of Multi-Asset Strategies. So Alessia, I'm going to turn to you first for this first round of questions. We've just heard that domestic demand is growing quite rapidly in emerging economies that historically relied on exports. So where are we exactly in this phase of development, according to you?
So yes, of course, let's say that exports still matter for emerging markets. So in these challenging and global conditions, emerging markets are simply diversifying by products, so delivering more finished goods and not only parts or commodities. They are diversifying by country destinations from south to south. Now, going to your question and the shift that we are witnessing from external-driven demand to domestic-driven demand in emerging markets, this is an indication of these countries, these economies maturing. And normally we assess what's happening on the domestic economy through investments and consumption. Let's start from consumptions. I think we heard in the previous panels that the set of consumption goods and services in emerging markets is broadening. Actually, we can refer to premiumization in emerging markets, and we heard that in the previous panel. Second, the rise of digital platforms, rise of e-commerce is allowing business to reach more remote customers. We can think about the rural parts of India, the remote islands in Indonesia. So digital and digital platforms are actually supporting that. On the investment side, three main factors are relevant. One is the infrastructure gap that is narrowing, and India is an excellent example of that. Second is emerging markets are moving to downstream, so from extraction to processing in order to retain domestically more value. And third and last, emerging markets are finally competing with developed markets. And in a case, an excellent example is the China tech race with US.
Thank you very much for that, Alessia. Okay, so what does this mean, Francesco, in terms of asset location?
Now, once upon a time, we were used to look at emerging market as a single cluster of countries with superior level of growth, arguable governance, and pretty much all of them devoted to export. When we wanted to do something defensive, we were looking into India, and when we wanted to be more aggressive, maybe we were turning to China. This story is ended, it's rubbish, doesn't work like that anymore. Now emerging markets are countries that are clearly specific in asset allocation. Countries like China, India find already an important space, and we think that in the future will be the time of Brazil, will be the time of Mexico, probably the time of Indonesia. What happens in emerging market is what has been described before from the previous panelists. So big changes in motion, a lot of themes developing. I'm not here to repeat what you heard already, but you may look, for example, of countries like Indonesia positioning themselves higher in the value chain, and so attracting the interest of Chinese companies producing batteries there rather than selling nickel internationally. So what's happening, it's the fact that emerging market needs to grow up dramatically in terms of market capitalization in global portfolios. They need to reflect the fact that if we take the Amundi Institute forecast in terms of global growth this year, probably they account for 70% in terms of global growth. So the capitalization is much smaller, doesn't make a lot of sense. So we are talking about investments that will move from being a nice satellite trade to a core component of the portfolios.
Thank you very much, Francesco. So investors, Alessia, are still very much focused on US policy shifts, but are there any economies out there that are somehow more resilient or could even benefit in the current environment?
Sure. So, as we mentioned before, with regard to the trade initiatives, the clear winners are countries that are, diversifying, trade partners, countries that are boosting their domestic demand and innovation. And India and China are a notable example of that. However, the policy framework out of the US administration is broader than trade. And indeed, when we invest in emerging markets, we need to understand the impact of this broader policy framework on key crucial factors, such as the stance of the core central bank, the Fed, the yields curve in the US, the US dollar, as well as the oil price. All these aspects are relevant to invest in emerging markets. Over the years, emerging markets have been substantially improving their policy framework. Today, emerging markets have larger buffers to navigate these challenging geopolitical conditions, this policy uncertainty that we have with us. Looking at the policy framework more in detail, on the monetary policy side, central banks in emerging markets today have a certain degree of independence. We were listening before about Brazil is a good example. So there are emerging market central banks that are hiking when the Fed is easing, and they have a larger buffer to decrease rates going forward. Brazil is a case, an example. On the fiscal side, normally when you invest in emerging markets, you seek for growth support because you want growth and earnings, or policy prudence. India is an excellent example. You have a country that is pursuing growth and at the same time fiscal consolidation.
Thank you very much. Now, Francesco, the performance of US assets has long been very important, crucial for emerging markets. With US treasuries and the dollar losing momentum as traditional safe havens, what are the implications for emerging markets as asset classes?
But positive, of course. So even in this late springtime, we are assisting to a coming back of flows into emerging market equities. We are seeing countries like Korea that maybe tomorrow will not be any longer an emerging market. We are seeing Taiwan, we are seeing China, Hong Kong doing greatly, anchored to the themes of artificial intelligence again and a big fiscal stimulus to stimulate that. But I think that besides the thematic approach that in emerging market will become a driver of performance moving forward, think about the infrastructure, what you heard about India, think about technology in China. Probably, like you said, the most interesting part is to look to the fixed income, is to look at what is going to happen in order to make sure that portfolios will be more resilient. And we think that the role of emerging market bonds, the role of countries that will have their own central bank cycles, that will be more independent from the Federal Reserve in the future, will increase a lot, probably not only in hard currency, but because of the sliding of the US dollar, also emerging market in local currency will become a very interesting core part of the portfolios.
Well, Francesco and Alessia, many thanks for your insights. We're going to switch from emerging markets to energy transition next. But beforehand, I'd like to thank you once again for your contribution here. Many thanks.